Sajjid Chinoy is India economist at JP Morgan, and he's joining us right now. Sajjid is not as optimistic about the pace of economic recovery that many are already building in. He's writing that one needs to put in sharp contrast what expectations of economic recovery are as against the euphoria which is being built around the election outcome. Sajjid, welcome to the show. Great to have you with us here. I want to start with exactly that same point. Is the market participants, economists, generally speaking, overdoing the euphoria? Because, as you point out in your recent report, the underlying growth, as pointed out by high-frequency indicators, remains pretty weak.
Exactly, and I think the contrast is important here. There's a lot of election excitement, and everybody's focusing on the exit polls and the results next week. But all of that optimism bordering on euphoria stands in pretty stark contrast to the reality on the ground. I think the fact is the first quarter GDP numbers, at least the high frequency data, tell us that they'll print around 4.6 or 4.7%. That would take the entire fiscal year FY14 to about 4.6 or 4.7. And that's a pretty sobering number. Remember, this was a year with an incredibly strong monsoon, a very strong harvest, agricultural growth at 5%, and you still end the year well below 5%. So I think that's the first point to note. And I think going forward, I think what markets need to realize amidst all of this optimism is that there is very little room for traditional counter-cyclical fiscal or monetary policy. We can talk about this later, but monetary policy, I think, will have to be tight even if there is no El Nino and you have a normal monsoon. There is a fiscal roadmap laid out, and I think any new government led by whichever party will have to adhere to that quite closely, given the scare of an external ratings downgrade. So the new government of whichever party will not have the benefit of using either fiscal or monetary policy. In fact, both might be a drag on growth, and I think that's why we need to be realistic about growth prospects in the coming months, and I need to be careful that expectations in markets don't get ahead of themselves.
But would you say, many say that, okay, forget the election euphoria. The economy is bottoming out anyway. So what are you worried about? The new government anyway will start. Whoever comes to power will start at a great advantage because the base is low. That's the argument given. You don't agree, right? Please explain that, Sajjid.
Yeah. So, I don't agree that the economy has necessarily bottomed, and I'll tell you why. Yes, the base is low, but the base of IP growth has been low for the last 3 years, and that hasn't helped IP growth at all. If you look at what the March numbers are, it will come out next Monday, around the same time as the exit polls come out actually, you'll get another number that contracts. And it's not hard to see why the high frequency data are not responding. You had the April PMI, the headline number was flat, the internal details of activity were very weak. Output is down, new orders are down, the new orders to inventory ratios at a 6-month low. You had the services PMI, it's been below 50 for the last 7 months, so it's in a sort of contractionary zone. You've had generally quite weak non-oil, non-gold imports, a series of negative IP prints. I think it's premature to say that the economic growth has bottomed. Now, I'm not saying that growth cannot accelerate later in the year. Of course it can. But right now, there are no signs to suggest that's the case. And you can see why. We got data from the first quarter of the US. US growth in the first quarter will actually be close to -1%. So even the external demand lift that people were expecting in the last few months from the US has not materialized. Now, will growth reaccelerate? Possibly. But if you look at domestic investment at home, which is quite stagnant, the fact that exports have fallen off the last 2-3 months, by all accounts, consumption remains weak because real wages have moderated. And the fiscal drag that kicks into place next year, there's a 0.5% of GDP fiscal consolidation. I'm not sure one can say that economic growth has necessarily bottomed just as yet.
But is it, out of the last 3 years, when you said, well, IIP seemed like it is bottoming, right? And we've been all saying that and debating that for the last many years now. Do you feel that now we are in a better place when you look at the last 3 years? At any point, we are in a better place? Or that again is debatable?
I think you have to break it up in terms of external demand and domestic demand. if you have a year in which the global economy grows meaningfully, and you get a pickup in the euro area, you get a pickup in Japan, notwithstanding the slowdown in China, then yes, if exports were to grow this year, then that would be a support on IP. But if I look at domestic demand, there's nothing to suggest just as yet that IP is about to turn the corner. You've had very weak capital goods production over the last year, and nothing to suggest just as yet that all the projects that have been cleared by the last government are about to be executed on the ground. If that does not happen, it's hard to see any pickup in IP. We've already mentioned that stubbornly high inflation has eaten into purchasing power and consumption. God forbid you get El Nino or something like that and food inflation were to rise, that will impinge on both rural and urban purchasing power and rural and urban consumption. So if domestic demand is not firing, and there are some question marks about external demand, given what we just said about US growth and the fact that China is slowing, you need some trigger for IP to grow, and it's not clear what that trigger is just as yet.
So why this? Is it just pure snazzy marketing going on? Because we're all being fed this constantly that, well, the worst is behind. Maybe the worst is behind. I don't think you disagree with that. But, a bull market is around the corner, and things are going to change dramatically. The pace is going to leave everybody surprised. I mean, you wrote a very detailed report. It was very well received. And we discussed this on air with other guests as well, highlighting the constraints that the central government will face and how a lot of the issues which need to be resolved in the domestic economy with projects, etc., the responsibility lies with states. We discussed that a bit the last time you were on the show. So my question is, are people being delusional? They just want to believe the story that, well, good times are going to be back very soon? Because, well, for 5 years now, it's all been depressing data and, lack of growth, basically.
Yeah. No, I think the narrative that's currently going around is that some of what happens in the real economy has to do with animal spirits. Confidence, animal spirits, and you need to get into a virtuous cycle. If you get a strong election result, if you have a stable government of either political party that tries to push on the reform agenda, tries to invoke animal spirits, can you get some lift? Absolutely you can in the second half of the year. I think no one's disputing that. I guess the limited point I was trying to make is that we need to be realistic about what this lift is. I think it's very unlikely to believe that India's economy can go from less than 5% to 7% growth in 4 quarters or 6 quarters, which is what I presume is underpinning the current market rally, for precisely the reasons you mentioned, that there are very real issues on the ground. A vast majority of the constraints actually lie at the local and state level, over which a new government, however well-intentioned, will just not have jurisdiction, whether it's land acquisition or power tariffs for state electricity boards or leakages or theft over there. You have a pretty significant leverage issue in the infrastructure sector. And while that will get better if capital markets remain buoyant, that deleveraging is going to take some time to create the balance sheet strength that entrepreneurs will need to finance the next capex cycle. And then we all know that, as we discussed, both fiscal and monetary policy will have to remain very tight in the foreseeable future, and you have to recapitalize public sector banks at some point if credit growth has to pick up sharply. So the issues I lay out are not insurmountable, but they will take many quarters to resolve. And I think we just need to be patient and be cautious that there is no miraculous economic turnaround that can be engineered by turning on a switch. This is a difficult process. It will be 2 steps forward, 1 step back. And I think markets need to have the stomach to wade through that uncertainty in the coming months and quarters. That's the limited point I wanted to make.